There's a historical narrative that suggests gold has always been a safe haven during inflationary times. People cite the 1970s as the textbook example. During that decade, inflation in the United States soared, and gold went from around $35.00 an ounce in 1971 to over $800.00 by 1980. That's a compelling story until you dig into the details. If you zoom out and look at broader time periods, you start to see the inconsistency. After peaking in 1980, gold entered a two-decade slump. Inflation continued, albeit at lower levels, but gold prices declined or stagnated. Investors who bought in at the top and held for the long term saw their purchasing power erode, not protected. The idea that gold always keeps pace with inflation simply isn't supported by the data. In fact, over long stretches of time, gold's real returns hovered close to zero. That's because its price isn't directly linked to inflation. It's linked to human behavior, fear, uncertainty, speculative demand. When inflation rises and panic sets in, people rush to gold as a psychological shelter. But once those fears subside or policy responses stabilize the economy, gold often gives back, though inflation itself is complex. It's not just a matter of rising prices. It has many causes: monetary expansion, supply shocks, demand surges, labor market pressures, and each has different implications for different asset classes. Gold doesn't respond consistently to all of them. It's not a productive asset, so it doesn't benefit from wage growth or higher spending. It doesn't offer yield. So when interest rates rise to fight inflation, gold becomes less attractive relative to income-generating assets. In fact, one of the biggest headwinds for gold is a rising rate environment, which often accompanies inflation-fighting central bank policy. That's when bonds offer better returns, and holding gold, an inert asset with no yield, it becomes costly in opportunity terms. People also overlook the volatility gold brings to a portfolio. While it may serve as a short-term panic asset, it's far from stable. The very thing that makes it attractive in moments of crisis, its speculative nature, is what introduces risk during calmer periods. You can have years of negative real returns waiting for the next crisis to justify holding it. That's not a hedge, that's a gamble. Contrast that with other inflation hedges. Certain equities, especially those in sectors like energy, commodities, or infrastructure, can adapt to inflationary conditions. They can raise prices, maintain margins, and pass costs along to consumers. Real estate often appreciates with inflation and can offer increasing rental income. Treasury inflation-protected securities, TIPS, provide a direct mechanism to adjust for inflation. These are assets that work within the system rather than outside of it. They're linked to productivity, cash flows, or legal instruments tied to inflation metrics. Gold is linked to none of that. There's also a psychological cost of misunderstanding gold's role. When investors treat gold as a reliable inflation hedge and it underperforms, it leads to disillusionment and poor decision-making. They sell at the wrong time or double down based on emotional logic rather than strategic analysis. That story might work in specific moments, but it doesn't hold up across cycles, decades, or different economic regimes. The modern financial world is more complex than the simple gold standard era. Central banks have tools: monetary policy, fiscal coordination, regulatory frameworks that influence inflation dynamics far more than in the past. Betting that gold will behave the way it did 50 years ago assumes the system hasn't evolved, but it has. Markets are more efficient, investors are more sophisticated, and assets are priced with far more nuance. Gold still has a role in some portfolios, not as a core inflation hedge, but as a diversifier in times of extreme tail risk. Think of it as insurance for moments when trust in fiat systems breaks down or when geopolitical uncertainty freezes traditional markets. In that context, gold can provide balance. But that's not the same as saying it should be a primary defense against inflation. That distinction matters. Imagine standing at the edge of a vast desert, holding a gleaming piece of gold. It shimmers under the sun, captivating and timeless. But as you journey forward, you realize that while it dazzles, it doesn't guide you, feed you, or shelter you. It's beautiful, yes, but is it truly beneficial? When evaluating an investment, one of the most fundamental principles to apply is whether the asset produces value, whether it generates cash flow, whether it creates something new, whether it contributes to productivity in the economy. Gold doesn't do any of that. It just sits there. Now, that doesn't mean it doesn't have value. It has had perceived value for thousands of years. And there's a reason it's been used as a medium of exchange, a store of value, and even a symbol of wealth across civilizations. But the question we're asking today isn't whether gold has historical or emotional value. The question is gold a good investment in today's world? And the answer is far less romantic than the metal itself. So gold is a non-productive asset. That means it doesn't generate income, it doesn't pay interest, it doesn't provide dividends, it doesn't produce goods or services, it doesn't employ people, it doesn't innovate. When you own gold, your return is entirely dependent on whether someone else will pay more for it in the future. That is speculation, not investment. Contrast that with owning a share in a company. When you own equity in a company, you own a piece of a machine that produces something, products, services, solutions, while generating earnings. Over time, those earnings either get reinvested to grow further or are distributed to shareholders. It's a self-reinforcing mechanism. Businesses, particularly well-run ones, are productive by nature. They generate real economic output. Gold doesn't participate in that system. It doesn't grow. It doesn't adapt. It doesn't scale. It's inert. And in a world that is defined by technological evolution, productivity gains, and capital efficiency, holding something that doesn't grow is essentially betting against progress. That's not a great position to be in long term. Think of it this way. If you bury a bar of gold in your backyard and come back in 30 years, it will be exactly the same. If you invest that same capital into a diversified basket of productive companies or real estate, the odds are very high that your capital will have grown meaningfully, compounded by innovation, reinvested profits, and time. That's not theoretical. That's what the data shows over the long arc of history. People sometimes argue that gold acts as a store of value, a hedge against uncertainty or inflation. And yes, in moments of extreme panic, wars, financial crises, runaway inflation, it can perform well in the short term. But those moments are episodic. They are not the norm. And even when gold rises during those periods, it often underperforms other inflation-protected or productive assets in the recovery. Over long periods, the real returns on gold are modest at best. Adjusted for inflation, gold has barely kept pace with the purchasing power of money over a century. Meanwhile, stocks and income-producing real estate have multiplied wealth many times over. The evidence is clear. Productive assets win over time. There's also an opportunity cost to consider. Every dollar tied up in gold is a dollar that's not working for you. It's capital that could be compounding elsewhere. And in a world where global capital is increasingly flowing toward innovation, sustainable energy, artificial intelligence, and other exponential technologies, putting capital into something that doesn't create any value seems not only inefficient, but irresponsible. Let's also talk about the psychological aspect of owning gold. Many investors are drawn to it out of fear of currency collapse, systemic breakdown, or loss of trust in financial institutions. That fear isn't entirely irrational. Our monetary system is based on confidence. Fiat currencies can be printed. Governments can mismanage fiscal policy. History has shown that systems can fail. But if the rationale for owning gold is that the system might collapse, then you're implicitly assuming that everything else fails to equities, bonds, banks, institutions. If that really happens, gold might be useful, but so would food, water, ammunition, and shelter. In such a scenario, your investment portfolio becomes irrelevant. The whole framework breaks down. We shouldn't build our financial strategy around collapse. We should build it around resilience, allocating capital toward diversified, productive, and adaptable systems. That's how economies grow. That's how wealth is created sustainably. Gold doesn't contribute to that growth. It's not a part of the engine. It's like putting a decorative hood ornament on a car and expecting it to make the engine run better. And let's not ignore the momentum bias that surrounds gold. Its popularity rises when markets are volatile or when inflation dominates headlines. But that's reactive, it's emotional, and emotional investing is dangerous. A disciplined investor allocates capital based on long-term principles, not short-term headlines. Productive assets might fluctuate, but they have intrinsic drivers of value. Gold, at its core, is driven by perception, and perception is fragile. So when you strip away the mythology, the tradition, the fear, and the speculation, what you're left with is this: gold is not a productive asset. And in a capital-based system that rewards productivity, innovation, and growth, that makes gold a weak long-term investment. It can have a role, a small one, in a diversified portfolio as a form of tail risk hedge. But it's important to see it for what it is. It's not a source of growth. It's not a creator of value. It's a passive object whose future price is determined by the hope that someone will buy it from you at a higher price down the road. That's not investing, that's hoping. And hope, while emotionally satisfying, is not a strategy. Inflation is a phenomenon that eats away at the purchasing power of money. Over time, what you can buy with a single unit of currency diminishes unless your assets grow at a pace that keeps ahead of it. That's why investors are naturally drawn to assets that can hedge against inflation, assets that preserve or ideally increase their real value as prices rise. Gold often gets named in that conversation, but that association is built more on perception than consistent performance. In reality, gold is an unreliable and volatile hedge against inflation. To hedge inflation over time, the better strategy is to own assets that grow, adapt, and produce value, businesses that sell essential goods and services, properties that provide utility and income, financial instruments designed to track inflation directly. These aren't speculative, they're systematic. Gold, on the other hand, reflects perception, and perception can change in an instant. That makes it unstable, unreliable, and fundamentally misaligned with the goal of consistent inflation protection. It may work occasionally, but not consistently. And in investing, consistency is everything. When you step back and look at markets over time, one thing becomes clear. Assets tied to real economic output tend to outperform assets that are based on sentiment. That's because productive assets have intrinsic drivers. A company generates revenue, reinvests it, expands its operations, and compounds its value. Real estate generates rental income, appreciates over time, and serves functional economic purposes. Bonds pay interest. Each of these has a cash flow, a tangible connection to value creation. Gold does none of that. It doesn't generate yield. It doesn't reinvest. It doesn't grow earnings. The price of gold depends entirely on the willingness of others to buy it at a higher price in the future, based on an ever-changing mix of fear, anticipation, and emotional psychology. That's not investing, that's speculation. And speculation, by its very nature, is volatile and unpredictable. When people talk about buying gold, they often focus on its perceived safety, its historic allure, or its role in uncertain times. But what they often miss is what they're giving up in exchange for that sense of security. That's the real cost of gold. It's not just the price you pay for the metal, it's the lost potential of what that capital could have done had it been allocated to something productive, something that builds. Gold doesn't produce anything. It doesn't create value. It doesn't generate income or dividends. It doesn't participate in the economy in any meaningful way. It just sits there. Its value is based on perception, what people think it's worth, not what it creates. Now, compare that to a business. When you buy equity in a company, you're buying into a machine that creates products, solves problems, earns revenue, pays employees, reinvests capital, and grows. That machine is constantly working, day and night, whether you're watching or not. The market for gold reacts to narratives. When inflation fears rise, gold often rises, not because it's intrinsically more valuable, but because people believe it should be. When geopolitical tensions spike, demand for gold may surge out of fear. When interest rates fall, gold can become more attractive simply because the opportunity cost of holding a non-yielding asset goes down. None of these factors are stable. They are situational, which means the asset's value is constantly at the mercy of changing sentiment. So when you're thinking about how to protect your wealth against inflation, ask yourself, are you buying something that grows with the economy and adapts with the times? Or are you clinging to a shiny object because it feels safe in moments of fear? One is a strategy, the other is a reaction. Knowing the difference is critical. Every decision in investing carries a trade-off. You're not just choosing what to do with your money, you're also choosing what not to do with it. That unchosen path, the road you didn't take, comes with a cost. That's opportunity cost. And understanding it deeply is essential to making intelligent financial decisions because capital isn't unlimited, it's finite. And every dollar committed to one place is a dollar that can't go elsewhere. The return you get from productive assets is driven by reinvested earnings, efficiency gains, innovation, and economic growth. The return you get from gold is entirely dependent on someone being willing to pay more for it in the future. And that price is often driven by emotion, fear, and speculation, not by output or performance. And that's a critical difference. When you choose gold, you're not just choosing an asset. You're opting out of all the growth that comes from owning pieces of the real economy. You're passing up companies that are disrupting industries, technologies that are scaling exponentially, and markets that are expanding. You're stepping aside from the compounding engine that has historically built wealth for generations. Let's quantify that. Over long stretches, decades, not months, equities have delivered real returns in the range of 6 to 8% annually. Gold, on the other hand, when adjusted for inflation, has barely kept up. Sometimes it outperforms in the short term, usually during crisis cycles or inflationary scares. But over time, the compounding power of productive assets dwarfs that of inert ones. Now, what makes this even more critical is time. Time is the greatest multiplier in investing. When capital is left to compound, even small differences in return become massive over decades. Choosing a lower return asset in the name of safety might feel prudent, but when that choice is repeated year after year, decade after decade, the wealth gap between the productive and the passive becomes enormous. That opportunity cost in action, not loud, not obvious, but relentless. Many people think of gold as a form of insurance, and in a narrow context, that's not entirely wrong. In moments of extreme instability, when systems are strained and trust evaporates, gold can act as a temporary refuge. But if you're allocating a large portion of your portfolio to that insurance, and the crisis never comes or comes only briefly, you're holding a deeply underperforming asset for long stretches of time. That's not insurance anymore. That's a drag. That's money that could have been working. This is not about ideology. It's about math and logic. The world rewards productivity. Capital, when placed in the hands of innovators, entrepreneurs, and builders, creates more capital. That's the essence of growth. Gold doesn't participate in that cycle. It's an asset that relies on others stepping out of the productive economy to assign it value. That's inherently inefficient. Another layer to this is behavioral. People are often drawn to gold, not because of its performance, but because of its symbolism. It feels timeless. It feels safe. But those are feelings, not outcomes. Feelings don't generate returns. Results do. And in a capital system, your results are shaped by the quality of your decisions and the clarity with which you understand trade-offs. If you're seeking to preserve wealth across generations, you have to think about how that wealth works while you're not using it. Is it compounding? Is it building? Is it being reinvested into systems that grow? Gold doesn't do that. It sits. It waits. And while it waits, inflation chips away and productive assets race ahead. Some will say, but gold held its value for thousands of years. That may be true in a relative sense, but the economy we live in today isn't the agrarian or feudal systems of the past. We operate in a global, hyper-connected, innovation-driven ecosystem where value is created faster and more dynamically than ever before. Clinging to static assets in such an environment is a choice to be left behind. So the real question isn't just, should I buy gold? The real question is, what am I giving up by buying gold? That's where the decision takes on real weight, because every decision has a cost. And when the cost is missing out on decades of compounding innovation and growth, that cost is steep. Hidden maybe, but real. Capital should be treated like a worker. You want it employed in places where it produces more capital, where it compounds, where it builds a future. Holding it in gold is like sending it to an empty field and telling it to wait. And while it waits, the rest of the world moves forward. Gold's price is driven far more by perception than by fundamentals. That alone puts it in a category that is dangerous for long-term investors. Unlike assets that produce cash flow, innovate, or provide services, gold's value doesn't come from anything it creates. It comes almost entirely from what people think it's worth at any given time. And that's a fragile basis for an investment. Another layer to the speculative nature of gold is the narrative reinforcement loop. When enough people believe gold is a safe haven, they buy it, pushing the price up. That rise then reinforces the belief that gold is a good investment, drawing in more capital. This can work for a while, but it's not sustainable. At some point, expectations get ahead of reality, the narrative loses momentum, and the same loop works in reverse. Prices fall, confidence erodes, and capital flees. This reflexivity is dangerous because it amplifies both the upside and downside without any grounding in intrinsic value. The speculative nature of gold also affects how investors behave around it. It encourages short-term thinking. People tend to chase price movements, buying after big run-ups and selling after sharp declines. That behavior often leads to underperformance, even if the asset itself does okay. Behavioral drag is real, and speculation exacerbates it. It pulls investors into reactive cycles instead of strategic ones. In contrast, productive assets benefit from a long-term tether to economic growth. Even if prices fluctuate in the short term, earnings, dividends, and real value creation act as an anchor. That's what provides resilience during downturns and compounding during stable periods. Gold lacks that anchor. It floats in the sea of sentiment, reacting to every wave of emotion in the marketplace. It's also worth noting that in an environment where innovation, data, and automation are redefining investing, gold feels outdated. Modern capital markets are increasingly driven by algorithmic analysis, fundamentals, and real-time data. Assets that produce measurable outputs are easier to model, forecast, and understand. Gold resists that structure. It doesn't fit into modern financial frameworks easily. That makes it harder to integrate into a disciplined investment process. Another consequence of gold's limited use is its vulnerability to demand shocks. If investor sentiment shifts away from gold as a store of value, as it periodically does, there isn't an industrial base large enough to absorb the slack. That's a dangerous position. It means prices can fall sharply with little resistance. In contrast, even when speculative interest in industrial metals recedes, core demand often stabilizes the market because producers still need the material. There's a floor under the market that gold doesn't have. This isn't theoretical. It's what happens when an asset's value is not tied to cash flows or economic participation. The price becomes a reflection of mood swings in the market. In this environment, timing becomes everything. You have to be right, not just about what to buy, but when to buy and when to sell. And very few people get that right consistently. Speculation rewards the lucky or the extremely skilled in the short term. But over the long term, most are left exposed to large drawdowns or missed opportunities elsewhere. That volatility creates an illusion of opportunity. Gold may spike in price during certain cycles, leading some to believe it's a smart hedge or a strategic asset. But those spikes are often followed by long periods of stagnation or decline. The 1980s and 1990s serve as a perfect example. After a dramatic surge in the 1970s, gold entered a 20-year period where it underperformed almost every other major asset class. Investors who bought into the narrative at the peak were left holding an asset that produced no income and lost real value for decades. So the question becomes, why allocate meaningful capital to something so unmoored from fundamentals? If the goal is capital preservation, there are more reliable tools. If the goal is growth, there are better vehicles. And if the goal is crisis protection, diversification into multiple uncorrelated productive assets often performs better across cycles than relying on a single emotional refuge. Speculation might have its place in small doses. For some, it scratches the psychological itch of holding something real or preparing for extreme events. But let's call it what it is. Speculation, not investment. And that distinction matters because once you're honest about what an asset is and how it behaves, you can start making decisions that align with your goals, your risk tolerance, and your long-term vision. Without that clarity, you're just guessing. And guessing is a dangerous strategy when it comes to building and preserving wealth. When evaluating any asset's long-term value, one of the most important questions to ask is how much real-world demand exists for it beyond speculation. That question helps separate assets that are foundational to the global economy from those that simply ride waves of market psychology. In the case of gold, what often gets overlooked is that its industrial use is limited, severely limited. And that matters a lot when you're thinking about long-term sustainability of price, utility, and fundamental value. Gold is used in some industries, yes, electronics, aerospace, dentistry, even some medical applications rely on gold for its unique conductive and non-corrosive properties. But the scale of that usage is relatively small compared to the broader market demand for gold. The majority of gold demand doesn't come from factories or technologies. It comes from jewelry and investment categories driven more by culture, emotion, and perception than by necessity. That's a critical distinction. If the value of an asset is largely supported by industrial utility, it tends to have a built-in floor of real demand. Copper, for example, is embedded in everything from housing to transportation to energy systems. Silver, too, plays a significant role in industrial production, solar panels, and electronics. Their prices reflect not just market mood, but actual economic activity. So when construction increases, copper demand rises. When manufacturing grows, silver gets pulled into the supply chain. These are tangible, grounded drivers of value. Gold, in contrast, doesn't have that level of utility. Take away jewelry, demand, and investment flows, and you're left with a relatively minor industrial footprint. That makes it vulnerable to shifts in perception, to changes in monetary policy, to investor sentiment, because when most of the demand for an asset is based on the idea that it's valuable rather than on its necessity in the real economy, that value becomes adapted, susceptible to rapid shifts and long stagnation. This limited industrial utility also means that gold lacks a consistent economic correlation. You can't reliably tie its price to GDP growth, manufacturing trends, or consumer behavior in the way you can with other commodities. It behaves more like a collectible in that sense, subject to cycles of popularity, scarcity narratives, and fear-based buying. And as with any collectible, the moment interest wanes or a better alternative arises, value can erode quickly. Think about how technological change affects industrial commodities. A breakthrough in renewable energy can increase demand for specific metals. A boom in electric vehicles can drive massive consumption of lithium, cobalt, and nickel. Gold doesn't benefit from any of these dynamics. It's not essential to future infrastructure. It doesn't fuel innovation. It doesn't scale with technology. So while the world moves forward, digitizing, automating, electrifying, gold stays still, dependent on the same old narratives of fear and safety. It's also important to understand how price stability and growth in commodities are reinforced by their embeddedness in supply chains. When producers rely on a material, they hedge its cost, they contract its future supply, they build it into their capital expenditures. That creates layers of persistent demand, which support pricing and liquidity. Gold doesn't have that kind of industrial anchoring. A few grams here and there in electronics and satellites doesn't compare to the tonnage of materials like steel, aluminum, or copper that underpin our built world. This reality affects long-term price behavior. Gold may surge during crises when people seek refuge or hedge currency debasement, but outside those moments, its upward trajectory is uneven and often disconnected from broader economic productivity. That's because its utility doesn't expand with the global economy, doesn't scale with population, development, or innovation. It exists in a relatively fixed narrative space, useful perhaps in a narrow window, but not growing in value creation as the rest of the world advances.
Even jewelry demand, which is often counted as a real use, is discretionary. It ebbs and flows with income levels, cultural trends, and generational preferences. As wealth increases in emerging markets, yes, gold jewelry consumption may rise, but that's not industrial use. That's aesthetic, social, and symbolic, and symbols change, preferences shift. Generations redefine what they value. We're living through a period of rapid transition. The global economy is rewiring itself around sustainability, digitization, and energy transformation. Materials that matter most in that process will likely gain value because their demand is tied to real use in solving real problems. Assets like gold, which do not play a central role in that transformation, risk fading in relevance unless continually propped up by belief systems and legacy narratives. So when evaluating gold as an asset, the absence of deep industrial demand should raise serious questions. Where does lasting value come from if it's not tied to cash flows, productivity, or real-world utility? The answer is, it comes from belief, and belief alone is not a stable foundation. Especially not when there are countless alternative assets with growing industrial relevance and strong economic correlation. Gold may have had a place in past centuries when economies were slower, systems less complex, and money tied to physical commodities. But in the world we live in today, dynamic, interconnected, and innovation-driven assets are increasingly judged not by what they represent, but by what they do. Gold doesn't do enough, that's the problem. And until that changes, it will continue to lag behind in a system that rewards contribution, not just tradition. In the grand tapestry of investment, gold is a thread, shiny and alluring, but not the fabric's strength. As we navigate the complexities of modern finance, let's seek assets that not only shine but also serve, grow, and build a resilient future.